Hello. Today I wanted to talk about a topic that has been coming up a little bit more recently in the past, and that's been discussions among traders about whether or not the increased volatility we've seen in the markets is a reflection of the fact that the markets are simply random, if they're able to be predicted at all. And what does that mean for trading and our trading strategies, especially if you trade using an automated strategy? Well, there are a number of influences on the market these days, and sometimes as traders, having an understanding of these different factors and what they mean for price movement and your predictability of your trading approach, whether that be a manual approach or an automated approach, is pretty important. There are a number of influencing factors on the markets. It could be interest rates, news stories, both positive and negative stories, market sentiment. What do investors simply feel about the particular market that you're trading? It could be related to fundamental economic conditions, global economic factors, what's going on in China, in Germany, in Europe, and all of those things. Many, many, many more. What we have to realize, though, is that the markets today are extremely nonlinear. Now, what does that mean? Well, as price changes over time, they are very sensitive to small changes in the initial values of these factors that influence the market conditions. As a result, sometimes they appear to be unstable or almost random over time. No doubt that many of you have heard of, if you've not read, the information on a random walk down Wall Street. The idea that taking into account different factors, that essentially the price movement of the markets over time have appeared to be random. And yet at the same time, many traders have done very, very well in predicting the markets. Well, if you can predict them, they probably aren't random. So why is it that these days, and if you've read much in the news, you see that high frequency trading isn't really panning out to be the panacea that we thought it would be, that many automated strategies are having extreme difficulties, and that people building models that used to trade successful models, whether they be automated or manual, seemingly are becoming less effective, and in fact some of them are actually detrimental. Well, what we have to understand is all of those trading approaches and models are built on certain assumptions. And what I want us to see is that tiny differences in these initial conditions or changes in the market environment may become amplified until the conditions that were around when you successfully tested, traded, built your trading philosophy, model, whatever, the conditions that allowed you to arrive at the conclusion that, hey, I have a very successful trading approach. Small changes in the conditions now compared to back when you were testing and developing that model, these tiny differences over time become amplified until you get to the point to where these differences grow and continue to expound, and in the end the model behaves very differently today than it did previously. Well, what does that mean? Well, back in the late 50s, there was a scientist named Edward Lorenz. Perhaps you've heard of the Lorenz attractors and things like this. His work was later made into a movie called The Butterfly Effect. I don't know if you've seen that, but the basic idea was that sometimes very, very small changes in initial conditions are enough to completely change the outcome, such that in theory, as was being proposed back in Lorenz's time, that a butterfly flapping its wings somewhere on a different continent could actually give rise to huge hurricanes and massive changes in weather, because those small changes in air current get amplified into a bigger and bigger effect that no one could have predicted. Well, Lorenz stumbled across this by trying to build models that would predict the weather. And sometimes traders feel like they would be pretty good weather predictors because the markets are seemingly more complex than that. And the story from Lorenz came about that he was simulating weather patterns and trying to predict the weather. In the middle, it says, I stopped the computer, typed in a line of numbers that it had printed out earlier, and set it running again. I went down the hall for a cup of coffee and returned after about an hour, and the numbers that the model were spitting out were completely different than the old ones. So in other words, he stopped the simulation. He put in what he thought were exactly the same numbers, and when he came back, the model was producing completely different answers. And he wondered how in fact that could be. Well, as it turned out, the numbers that he put in were rounded off, just very, very small differences. And what he noted was that, in the second point right here, in fact, the differences were more or less steadily doubled in size every 4 days or so, until all resemblance with the original output disappeared. Now, what does that have to do with the markets that we have? Well, in a random system, sometimes people say, the markets are random, but in a random system, one of 2 or more things can happen next. Price can go up, or price can go down, or price can go sideways. However, in a chaotic system, the outcomes are fully deterministic. Now, what that means is that even though the outcomes are complex, the next thing to happen can be determined. In other words, even though the markets may be complex, they may be highly volatile, what is going to come next in the market can be determined. Does that mean you can predict the markets? It means that you can have a high degree of confidence that the market will behave in a certain way. Okay? In other words, the markets are not random. Okay? The markets are not random. They can be predicted, but often not by simple or linear methods. We talked about the butterfly effect, and this was first presented in a paper in 1963 given to the New York Academy of Scientists. One meteorologist remarked that if the theory were correct, one flap of a seagull's wings could be enough to alter the course of the weather forever. Now, whether or not that's true in the markets is yet to be seen. But imagine what would happen to the markets across the board if we had an extended day of extremely bad news about Apple and Exxon together. What would happen to the markets if Apple and Exxon had a day full of just horrible news and the outlook was abysmal? What influence would that have on a company that was actually prospering and doing well? Well, even though you may be trading the smaller company, the effects of what's happening around it will either pull it up or pull it down. So let's take a look and see at exactly what the outcome is here. Well, what we see here is a particular model about what's going to come up next. You can kind of think of it as this is a highly dynamic model, and it has, let's say, you've created the holy grail of models that predicts what price is going to do in the market from one time period to the next. What we see on the right side here, these different R values over here on the right, are slightly different inputs. So you start off the market and you change sentiment, or you change economic conditions, or you change what the Fed is going to do to interest rates, or you change bond yields. Things like this. What we see is that small changes, here's 286.25 right here on the blue line. You change it just a little bit, 287.5 on the red line. It surpassed it here and yet leveled off, and they eventually meet up. But you go back to the green line, 281.25, it's a little bit off, but look at the dramatically different outcome here. Basically, that in that conditions, prices would have diverged completely with what perhaps you would expect. So what does all this mean for traders? If we have these increasing volatilities of the market, if we have this fact that small changes in initial conditions have profound influences on what price is going to do. What does this mean for traders? Well, it means we need to be aware of a couple of different things. Number one is small changes in market parameters can mean that the market will behave nothing like past performance. So if you have a particular strategy or model and you're trying to optimize parameters across many different market conditions, what it means is that optimizing your trading system on 3 years or 5 or 10 years of historical data is likely to mean that it will not work in current conditions. Even though the market or the commodity or the stock that you're trading may have similar looking conditions now. They may have been, you had a stock price double, or it may have made a new 52-week high, or it may have been trading above its 50-period moving average or 200-period moving average, things like this. What it means is that what a chaotic nonlinear system means is that the more you train and optimize your trading system to behave with data that was long ago, the less likely it is to respond appropriately to current market conditions. Now, why is that? The main reason is that the current conditions are never exactly the same as they once were. And as time goes forward, these small differences are amplified by the market until the result is nothing like what you would expect given market behavior. So training your model and optimizing your model on 10 years worth of historic data, even 18 months worth of data, may not be the best idea. We see many up-down cycles in prices that never really repeat what happened in the past. It may be similar and it may behave in similar ways, but you notice that it never repeats exactly what happened in the past. And that's because the current conditions, although they may be similar, are never exactly the same. And as important factors change, even slightly, this causes unexpected behavior in price. It doesn't mean price is random, but it does show a sensitive dependence on current condition. Let's take a look at another example. Here's another example where we have similar model working over time, but what we have is very different predictions based on very small changes that we see here in the initial condition. So small changes in initial condition over time get amplified. And keep in mind that the market has been going for a while. And if we go back and look at what factors influence price behavior, we see that it's a whole host of things. Lawsuits, fundamental news, inflation, social sentiment among investors, overall exchange performance. It used to be that if you trained a model on Apple Computer and what Apple was doing, you would find that over time, Apple became more and more correlated with the NASDAQ. Well, that's because Apple became the largest single cap stock on the exchange. And so the NASDAQ essentially was Apple. And what that meant was that other stocks, regardless of what they were doing, their performance was being pulled around, being influenced by what Apple stocks were doing. Now, in the past, that wasn't the case. And so if you optimize your model for what your little company was doing, independent of what Apple was doing on the NASDAQ, you probably had pretty good returns. All of a sudden, it stops working, and that's because a small change had a relatively big impact. One stock, the performance of that stock basically came to dominate the performance of that sector. Same for the tech sector. Same for oil and Exxon. And so these changes have profound influences on the way that price behaves. So, what does this mean about predicting market behavior? And this is especially true for neural network models because they must deal with this nonlinear behavior. And that's why they're often fairly close if you have the right mix of parameters, but they're never highly accurate. It's because over time, these small changes that were not involved in the training of the networks get amplified, and the error essentially increases over time. That's why the neural networks must be stopped and go through extensive retraining or relearning the new conditions all the time. Some of them even go through it every night, some of them over the weekends, so that when you start the week, a new set of parameters are in place. And yet, we don't often adjust our manually traded strategies or even our own custom automated strategies in the same way. But even though we don't, human traders must deal with this change in market performance as well. And one of the things that we're finding more and more and more is that linear statistical models often fall short. Now, what's a linear statistical model? Well, very simple things like simple moving averages, even weighted or exponential moving averages, stochastic indicators. Basically, all of the old linear indicators are not good at long-term prediction. Long-term meaning more than just a very narrow, maybe 15-minute time window of what's going to happen. So, the challenge. And one of the things with chaotic markets is the challenge of entropy or seeming randomness. As time goes on, disorderly movement of the market increases. And we've seen that here recently. As time goes on, we see an increase in the volatility of the market. And we see prices behaving in ways that we've never seen them behave before. Does it mean the markets are falling apart? No, not at all. It just means that the markets are chaotic and small changes in conditions are having a profound and unexpected effect on our ability to predict them because we're using slow linear statistical models to predict or identify conditions that were successful in the past but over time become less and less successful. Whenever you approach this or you see these things start to happen, many times what we find is that we say, well, the markets are becoming almost random and they can't be traded. And that is not true. A chaotic system is predictable. However, optimizing your training with long-term data is a mistake because the market conditions have changed. And so while some people argue for lots of back testing, lots of historical data, I've in building statistical models, I often see, well, what would have happened in 1982 or what would have happened in the crash in the 90s or what would have happened with the tech bubble in the 80s? I don't know. Because that time period has gone and those conditions will never exist. If the price goes up, you want to go long. If the price goes down, you want to go short. It may seem a little bit trite and obvious, but in predicting that, you have to understand that sometimes prices behave in chaotic but predictable manners. We also have to understand that chaotic markets are sensitive to initial conditions. In other words, what happens now, even if it appears very small, can have a very profound and unexpected effects in the market. For example, market news changes on investor sentiment. Let's take a look at that, see what that means. Here we have the YM chart on a 5-minute, and we see here that as we go along, price is fairly steady and trying to inch up, but what's sentiment doing? Sentiment is very negative. Over time, sentiment turns positive. And then what happens? Boom, the markets come on down. But as it's coming down, sentiment turns negative, 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 and stays negative. And then when it levels out here, once we go into this flat portion, it pretty much stays fairly negative. And as a result, it comes on down. Even though during this particular period, this is from June of 2013, This is during a period where overall the market was responding fairly favorably. This is at the end of a time period when the market is fairly optimistic. And so even though you would not have predicted this kind of performance given the other conditions around it, and given our past experience with similar conditions, you have to understand that if you look at the color of the sentiment just from the 10,000 foot overview here, sentiment is pretty negative, and things aren't going to go up when people have bad feelings about it. So what's the point here? What's the point with this idea of chaotic markets? Traditional linear indicators may not capture the nonlinear behavior of the market. And optimizing your trading models with data from far into the past most likely will not help make your trading more profitable. The market is indeed sensitive to small changes in the complex constellation of market conditions, and even small changes in these conditions will likely cause unexpected price fluctuations. Those are some of the things that we try to take into account whenever we build trading models. When is the market chaotic and when is it not chaotic? When is it behaving in a more linear or orderly fashion? And if it's not, we need to use more nonlinear tools to predict what's going to happen next. Otherwise, we're likely to simply be rolling the dice. And that's never a good thing whenever you're talking about market prediction.